Imagine 29,000 public companies, every listed American stock since 1926. How many created lasting wealth for shareholders? Most of them did not. About 57% failed to beat a basic Treasury bill over their full lives. And the market's net wealth was created by a tiny minority. Roughly 4% of firms did essentially all the work. Not most of it. All of it. This is the hidden shape of stock market history, a power law, where a few winners do almost all the work. In 2018, Hendrik Bessembinder compounded the lifetime returns of every U.S. common stock in the CRSP database from July 1926 through December 2016. This was not a survivorship-only study. Delistings, bankruptcies, acquisitions, and failures were all included. The question was simple. Over its full listed life, how often did an individual stock beat 1-month Treasury bills? The answer was brutal. Only 42.6% did. 57.4% did not. The median lifetime stock return sat below the Treasury bill rate. And yet the market as a whole created enormous wealth because the right tail dominated the aggregate. About 4.3% of firms created all net wealth above T-bills, and just 86 firms produced roughly half of the total. Later updates to 2022 and 2023 did not break the result. If anything, the concentration deepened. To understand why that histogram matters, compare two very different statistical worlds. In a normal distribution, extreme outcomes fade away quickly. Most observations cluster near the center, and the average tells you something useful about a typical case. A power law is different. Extreme values are still rare, but not nearly rare enough to dismiss. The largest outcomes can dominate the total so completely that the mean becomes a weak description of the typical individual. Mathematically, the tail follows a relation of the form probability of x greater than x is proportional to x to the negative alpha. Smaller alpha means a fatter tail and stronger domination by extremes. And on log-log axes, power laws reveal themselves by looking almost linear. That straight descending relationship is the empirical signature, and the far-right points belong to names like Apple and Microsoft. Why does this shape emerge at all? Because stock returns compound multiplicatively. If returns were additive, good years and bad years would offset much more cleanly, and aggregate outcomes would tend to bunch around an average. But investment returns do not add. They multiply. Terminal wealth equals initial capital times the product of 1 plus each period's return. Take logs, and the center of the process becomes a sum. That is why log returns can look well-behaved. Exponentiate the result back into wealth space, and the distribution becomes right-skewed by construction. Path asymmetry makes the intuition concrete. Up 50% and then down 50% does not return you to where you started. 100 becomes 150, then 75. And once volatility differs across companies and across time, the spread of terminal outcomes becomes even wider. That is why multiple paths with the same broad structure can end in a giant winner, a middling result, or near zero. The tail is not abstract. It has names and rankings. In the updated U.S. dataset through 2022, Apple created about $2.7 trillion of shareholder wealth, Microsoft about 2.1, and ExxonMobil about 1.2. Those top three alone contributed roughly $6 trillion, or about 11% of the full net total. The top 25 names created around $17.6 trillion, about 31% of all net wealth. And just 2% of listed firms created roughly $50 trillion of the $55.1 trillion total. What matters is not just the size of the winners, but how different they looked at the beginning. Apple, Microsoft, ExxonMobil, Alphabet, and Amazon came from different eras, different industries, and different economic mechanisms. The underlying mathematics stayed the same, while the stories looked completely different. This distribution has a direct implication for active stock picking. If most of the market's wealth comes from a small tail of names that are extremely difficult to identify in advance, then a concentrated portfolio has a structural chance of excluding the firms that matter most. That is why the underperformance curve rises with time horizon. The longer the horizon, the harder it becomes to dodge the mathematics of concentration. This is not proof that no active manager has skill. Fees, taxes, and turnover still matter. But the power law creates the floor underneath those frictions. A capitalization-weighted index solves one part of the problem automatically. As a winner compounds, its weight grows, so the index captures more of the tail without having to predict it early. This is where intellectual discipline matters. First, hindsight identification is free. Knowing who the historical winners were tells us nothing actionable about who the next top 4% will be. Second, lifetime returns are not annual returns. A company can deliver strong shorter windows and still end its listed life below Treasury bills. Third, methodology affects exact magnitudes. Bessembinder's inclusion of delistings makes the work more rigorous, but the precise percentages still depend on definitions, data handling, and sample choice. And fourth, this is not an argument against equity markets themselves. The market as a whole created massive wealth above T-bills. The power law describes how that wealth was distributed across names. So the finding is robust, but the implication is narrower than many people first assume. Broad diversification is mathematically rational under this kind of distribution. The pattern is not uniquely American. Global work by Bessembinder and co-authors found the same structure across roughly 64,000 stocks from 61 countries. Outside the United States, concentration was at least as severe. 61% of non-U.S. stocks underperformed Treasury bills over their full lives. And globally, 5 firms accounted for more than 10% of net wealth creation from 1990 to 2020. Recent sub-periods suggest the concentration may be tightening rather than loosening. The evidence is clear. The tail dominates the aggregate. The open question is practical. If you cannot identify the tail in advance, what does a rational response actually look like? So the clean summary is this. A tiny minority of stocks created nearly all net long-run wealth. The shape of that outcome is power law-like, not bell-curved. That helps explain why diversified indexing is mathematically resilient and why concentrated stock selection is structurally hard. But the evidence is historical, not predictive. It does not tell us who the next tail winners will be. This video is for education only, not financial advice, and real portfolios still face fees, taxes, execution limits, and uncertainty.